Welcome all to another week, another session. This is TFNN, and you are listening for the next hour to the Options Hour with Victor Jones, member of TD Ameritrade here. And over the next hour, of course, as always, we're going to be talking about options, and we've got a lot to talk about. The market's giving us a lot to talk about today. Not only that, but we are right in the really in the meat of the earnings season. So a lot to talk about, and really what we want to cover over the next hour, essentially, is in addition to all of your calls, is really essentially what's happening here in the marketplace. Obviously, we've got a significant update today. We're up about 1.5% on most broad-based indices. We've got some interesting tech movers today, some interesting finance earnings coming out a little bit later this week in addition to some tech earnings. So we want to talk, and we want to talk about the overall market, where we are sitting here at this 14, or approaching, I should say, rather, this 1,400 level. We're at 1,384 now in terms of the S&P 500. And we also want to talk about some upcoming earnings. I mean, we basically had coming into today about 35, 36, actually it was 36 of the S&P 500 companies had reported. At the end of this week, we should have basically 86. So 50 companies in the S&P 500, 10% of the S&P 500 are going to, or set to report this week. So it's going to be a very, very interesting week. A lot of opportunity, a lot of, I should call it, strategies in play here. And so we want to talk about as many of those as possible. As always, this entire hour is a call-in show, so as much as you'd like to call in to talk about those underlying securities, maybe you have a position, maybe you're looking at putting one on, give us a call at 877-927-6648. And again, if you've never traded an option before, it doesn't matter. Give us a call if there is something in play. And whether or not it's earnings or not, it could just be something you're in. It's level shifted as we've moved. We're up $20 here today. And you just want to talk strategy. Hey, this is what I'm at. How do I repair what I've got, or how do I look to further improve my position? Again, 877-927-6648. As always, we want to start the show with a quick market wrap and where we are right now. The S&P 500 currently 1384, up $20 even on the day, and that's if you're counting just shy of a 1.5% move to the upside. We were hanging right around 1365, 1364 and a quarter at the close as of yesterday, and we've made a significant move again, up $20, 1.5% to the upside. And if you remember here in the S&P 500, really, we've made a high earlier this year, I want to say about 2.5 weeks ago, early in the April expiration cycle of 1419.75. We're now about 30 points below, a little bit more than 30 points, just say about 35 points, 36 points below that high we've made. So we still got a lot of room to play there before we start approaching those highs. But as we've made basically a support, a little bit of bounce off 1350, the 1350 area up twice, which shouldn't be much of a surprise from a technical support standpoint. That's essentially where you saw a bit of a resistance area before making the move or making an approach to 1400. Let's talk quickly about the NASDAQ, because as you know, the NASDAQ was a little bit weaker than the Dow Jones yesterday. The NASDAQ today, 2,711.5, up 47.75. That is just a little bit over 1.75%. So the NASDAQ outperforming the S&P 500 today just a bit. And then we also have the Dow. The Dow, 13,040 points, up 190 points, made a significant rally, up right in lockstep from a percentage basis with the S&P 500. The Dow and the S&P 500 moving in lockstep, 190 points to the upside, which is what you would expect. We've now made, again, a significant move above that 13,000 level. So, if you look at really where we are in terms of these levels, we're at major support/resistance areas, depending on which side of the fence you're on. Again, and it's the market is giving us these great opportunities here at these significant, these round numbers to basically position ourselves. And there has definitely been two-way trading here. If we just look at where the high's been, just again, a couple of trading sessions ago, early in the April expiration cycles, 13,245, essentially 200 points higher than where we are today. And so again, there is definitely a two-sided market here. We are excited about that, and we're excited to talk about some strategies here as we approach the later part of the show. As always, if you want to talk about your own strategy, you're more than welcome to give us a call at 877-927-6648. Moving on from broad-based indices, we want to talk about the VIX. The VIX is down 174. That is almost 9% on the day to 1781. And for those of you, if you've never heard of the term VIX, that's the volatility index, which tracks the S&P 500. And why this is so important as an index is it's essentially the fear gauge of the marketplace, and it typically has an inverse relationship with the direction of the market. So as you see the overall markets or the equity markets climbing higher, you would typically expect fear to ease a bit in the marketplace, and the relationships or the percentage relationships, the deviations, the convergences that can happen based on the VIX and the equities markets can sometimes provide us interesting signals. So we always keep an eye on that. But more importantly, when you talk about options, and we'll get into this in just a bit, but when you talk about options or trading options, it's more than just a price game. You're trading stock, it's a price game. Are we moving up? Are we moving down? When you start to get into options, there's more things in play here. There's time, right? Because we all know options expire at a certain date. And because of that, there's extrinsic premium, or there's time premium that's factored into option pricing, and how we use that either for us or how it works against us in our strategies. There's also volatility. So volatility in the market or uncertainty about future price direction or magnitude of move also plays into the price of options, which is why it's so important that us as options traders, or as people who are monitoring the market in general, have a good feel of what the VIX is doing and telling us. If I could, kind of give an anecdote to I think why the VIX is so important. I mean, if you look back to where we were in 2008, and you saw a VIX that was essentially at 50, 75, even at 90% levels, that was telling you, it didn't take a genius at that point in time to know that the market could easily move 300, 400, 500 points in one direction or the other. But mathematically, the VIX was telling you that was a possibility. And because that was the case, you could come into the market on a day-to-day basis and understand what the real risk was in terms of the S&P 500, in terms of what type of movement to expect. Now, you come in and you see 17% volatility. You might expect, 1%, no more than 1.5% move on a daily basis at best. And today you're getting about a 1.5% move. So as an options trader, or just as somebody who follows the market in general, you get the opportunity to quantify the magnitude of movement. And here's why that's so important to everyone out there, and I appreciate all of the listeners, whether you're in the Tiger Den, whether you're listening on the radio, on iPhone, iPad, doesn't matter. TFNN's really taking over the world and the devices out there, but here's why that's important. With earnings coming up over the next week, and with 50, as I mentioned, 50 of the S&P 500 companies announcing over the next week, it's so important that we understand what the VIX is to the overall market, because there's a such thing as a VIX for an underlying security. Not only that, but the ThinkorSwim technology offered through TD Ameritrade actually offers you the ability to look at an underlying security and essentially say, so-and-so or XYZ has earnings coming up. And to use a real-life example, obviously we've got IBM earnings coming up after the close here. So we've got earnings coming up after the close. What is the expected move based on that volatility information? And, if we look at a few of these out there, we should have, let's see, Bank of America might provide it for us. So as we go through and we look at a few of these, you can see this market maker move in the upper right-hand corner. And again, if you're listening through the radio, I'll try to make this as apparent as possible, but you're going to get, in the upper right-hand corner, you'll get the ability to essentially quantify the movement based on earnings. And we're going to go over that. But it has a lot to do with volatility. So as we move in past the VIX, we want to talk about the dollar really quickly. 79.70, a little bit cheaper here. The dollar in terms of, and that's the dollar versus, that's the DX, /DX futures contract that tracks the dollar against a basket of world securities. Again, 79.70, down 3 cents on the day. The dollar is a little bit weaker to a basket of several securities. Gold, 1652.30, up $2.60 on the day. Gold a little bit strong today, which is interesting. But the dollar being weaker, that makes a little bit of sense. You also have crude, which is, again, a little bit stronger on that dollar weakness here today. 104.39, up $1.45, which is about 1.5% as well. So some very interesting moves, and as always, what we like to do is start off the show with kind of that market wrap, where we talk about the overall market indices, and also gold, crude. But as more and more, Apple is starting to become a barometer. It's not just understanding what Apple is doing. You're also understanding what essentially the Nasdaq is doing. But to a certain extent, you're understanding what the market is doing. And even though Apple has had a significant run, some may see a parabolic run over the last, several months from basically their last earnings announcement. I mean, their last earnings announcement, if you can remember, 420 was essentially that upside resistance area, which it crept right up to 425 into an earnings announcement, and basically, gap $20 higher immediately following that earnings announcement. It's just been up and away since then. Yesterday, Apple was down 4%. Today, up 3.25%, $19 to $599.17. So it made a move off again to about that 380 area. And now almost, if there ever was a story of something that was every time it gave something up, is essentially a buying opportunity over the last couple of weeks. This has been one. Now, keep in mind, obviously, that was a 5 trading session slide for Apple into the 580 area from about 644. Ever since it made that high, it slid off again to about 570. We're now rallying to 599.25. And what's interesting about Apple, I think interesting about the setup here, is you're now seeing, into iPad 3, you saw a lot of momentum build. You also saw a lot of euphoria in the market. A couple of analysts came out and gave their $900 to $1,000 price targets in Apple, which kind of accelerated buying here. But I think there's some interesting metrics that are going to be factored in here. So we talk about things like Intel, who reported yesterday, Monday, with global chip revenue up 1.8%. If you could remember, basically last earnings cycle, it was actually kind of difficult for chip makers because there were some droughts, some things like that actually prevented a lot of chip manufacturing. So it hit revenues just a little bit. But here with Intel reporting, and now you're going to see some companies here over the next week, which could foreshadow, I think, what we're seeing with with Apple. I kind of foreshadowed when I was going to say Freudian slip there, but you have, again, AMD, another chip maker out there, so we get a little bit more of a feel for what's happening in this marketplace. And why is that important? Obviously, 50% of Apple's revenue is coming from mobile devices. I mean, 50% of Apple's revenue is coming from the iPhone, essentially. But I mean, there are some ancillary revenue generators from Apple. 12% of their revenue comes from the Mac. I think that's important when you factor in 13% also coming from the iPad. So, as you have a little bit later this week, you're going to have AMD, you're going to have IBM as well, which is going to give us a little bit of information on the software side in terms of IBM. But we'll get into that here in just a moment. But I think what's so interesting here is just understanding the movement here in Apple, understanding that it's giving us an opportunity to trade. So as we look again at the volume here in terms of Apple, we've already got 21 million shares traded on the day. If you can remember last year, the expectation in terms of units moved was about 30 million units, which was actually a pretty low estimate. It was at the last moment that was bumped up. It was actually lower than that. Apple came in with about 37 million units. But we do have, if you could, if you're keeping track, you do have earnings coming up for Apple here in just about a week or so. We're expecting 4/24, which is midweek next week after the close. We've got William on the line from Singapore, who has a question on Apple. William, you're on the air.
Yes, I am. How are you, Victor?
Good, William. Good to hear from you again.
Yes. I guess you know what I'm going to ask about the Apple. I think it's really very volatile. The last few days, you see them correcting, about 10%, which take them about 17 days to, go up to the same level. So with the earnings coming soon, and with this kind of volatility, I thought, I'm not sure whether to, maybe at this point, do a straddle at around $600. Say maybe May aspirations. And I checked that, in order to do that, for every contract, you probably got to pay about $6,300. So I was thinking that if I want to do May aspiration of $600 straddles, maybe I should actually sell a call on top at 620 and sell a put below at 580 to reduce the cost. Since I'm going to play on just earning, I'm not sure whether this is a good idea. So thought having your, advice.
Sure. And actually what you're looking at doing, it would be called something like an iron butterfly, really, where you're selling that that 600 straddle, and then you're buying the strangle basically behind it.
I'm buying the straddle.
Excuse me. Yep, you're buying the straddle here. It's really selling the opposite. So you're buying the straddle here with and selling the strangle outside to help pay for it, to help finance it.
Yes.
And I think what's interesting here, and you brought up something that's really interesting here, William, and that is typically when you see a move like this, there's an old saying that says the market typically, it likes to run up the stairs and fall off the cliff. And I think what we're seeing with Apple is almost similar. It's almost the opposite, which you're seeing a lot of strength in the buy side here. And why do I say that? Well, essentially you're seeing almost the equivalent in terms of the buy pressure here in Apple today that you saw yesterday on the sell side. Now, clearly, we aren't there yet. We'd have to recover, probably another 7.5 points or so to actually be there from a candle perspective, and also just from, to have that would essentially be a bullish engulfing pattern, maybe something similar to a piercing candle, but I think where we're seeing right now, you're seeing significant buying pressure here as we get ourselves ready for May. But I think what's interesting here, William, is you're looking to potentially buy the May straddle, is that you also have, if you look at basically what the difference is between the volatility differential of the front month, which is April, 36%, which is going to expire in 3 days, and 46% in the back month, you've got a 10% volatility differential between front and back month. So there's the opportunity here to potentially sell something in the front month against something in the back month. If you feel, again, you'll stay relative, there is, again, a little bit of volatility, but if you feel within the next 3 days or so that Apple will kind of stay in this range as it prepares or it gears up at least for expiration, if not for earnings on the next week, there's an opportunity in the front month to sell something against your back month position, whether that be a diagonal, or whether that be a couple of calendars. So I would say there is a little bit of opportunity in Apple having a little bit of increased volatility. There's still a 10% volatility differential, but there is a little bit of front month volatility. Typically, we don't ever look at putting on positions with less than 4 to 10 days to expiration. But I think this is an interesting opportunity because you are trying to get into a May position, and there might be an opportunity to use those 3 days to sell something against that May position. And then again, once you expire, you do have the opportunity to potentially put something on in May to further help finance that position. So I would say the strategy of selling something outside of the straddle, definitely, I mean, people, that's there wouldn't be any more risk here doing that into earnings than you would see anywhere else. It's just going to limit your upside. But the opportunity here is almost twofold because you do have the opportunity to do something in April, 3 days, and then roll that into May and potentially further finance what you've got going on.
Okay. So if that is the case, what strike should I use, for selling the front month?
Say it again?
What strike should I use, in the case that you have suggested?
Okay, great question. So I think if you look at essentially where we are. There's an old floor calculation really that's, okay, if I wanted to figure out essentially what the expected move based on earnings would be, what I could do, I'm going to show you this here on the software. I'm going to buy the at-the-money straddle. So really, if you're listening over the phone, in order to price this out, I'm looking at the May options for Apple. And the at-the-money strike right now, because we have broken 600. We're at $600.05 approximately. The at-the-money straddle is the 600 straddle, which is currently trading $63.85. So what I can do is immediately sell the first out-of-the-money strangle, which is the 605 call and the 595 call.
Okay.
And what I get is $4.90 approximately. It's $4.90. You divide that by 2, and that should be your approximate move in the back month, which it's tough right now because I don't think we're getting, we'd have to wait for that front month to expire for this to fully work. But essentially after the April's expire, you can take the at-the-money straddle, subtract the out-of-the-money strangle. You can divide that by 2, and that should essentially be your expected move going into Apple earnings. So what I would encourage you to do is probably look at that strangle that's closest to the expected move so that you get the most bang for your buck out of that straddle. Because essentially you're going to want something that kind of limits, at some point you're going to limit your upside potential, so you want to get the most bang for your buck. So I would, you want to take the expected move and look for the strangle that's closest to that expected move.
Okay. All right. Thank you very much, Victor.
Yeah, absolutely. Always a pleasure, William, and thank you for the call. And if we have any other callers as we're going through this here, I would encourage you, feel free to give us a call at 877-927-6648. Again, that number is 877-927-6648. Thanks again for the great call, William. And it brings up a great question. I mean, if we're looking at essentially the strategy behind what William is discussing, a straddle is a option position where you are simultaneously buying both a call and a put at the same strike. And why would you do that? Well, you would buy a call and a put if you were unsure of direction, right? You're unsure of direction, but as long as the underlying moves with some volatility, as long as it moves, at least if we're looking at expiration, as long as it moves more than what you're paying for that straddle, which in this case is $63. So if Apple were to move more than $63 from now until May expiration, that would be a profitable trade. So 664 to the upside approximately, and about 535 to the downside approximately. So essentially, William is looking for a strategy that says, I don't know which direction Apple's going to move. I think 600 is a very pivotal point, at least in his mind at this point. He thinks 600 is kind of a pivotal point as we're approaching earnings next week, which could mean he thinks we're either going to push significantly higher, or there's not going to be enough in terms of earnings to sustain this move, and we'll have a significant correction. And so what William is trying to do is find a way to finance that straddle. He's saying $63 is kind of expensive. That's like $6,400 he's going to have to put up for every one he wants to do. So essentially what he's saying is, how can I help to finance that $6,400 straddle? And what he's looking to do is potentially sell some out-of-the-money strangle. So if 600 is the straddle he's selling, he might go up a couple of strikes, and I'm just going to pick some for, to show the example here. He might sell the 615 call. He might sell the 585 put. And to show everyone what this looks like, at least if you're in the Tiger Den, tie the positions here, you can see what happens here. Essentially, if we move significantly in one direction or the other, that's where you capture your profit. And so he was looking at potential ways to do that, and I think there's a potential here to actually sell something in April versus May where you cap those gains. You could potentially sell something in April to help finance the back month and put less limitation on the potential upside of that position. So thanks for the call again, William. We talked about Apple really quickly, and I think there's some interesting. I know there's definitely some interesting news. Obviously, we want to talk about what's fueling this move. As you take a look quickly at the market again, as we reach the halfway point of our show, 1385.50, up 21.5 points in terms of the S&P 500. The Dow Jones 13,052 points, up $202, up 12 bucks since the last time we quoted. The Nasdaq up 2,714 and 3/4, up 51 points. The Nasdaq now approaching 2% up on the day. S&P up a little over 1.5%. The Russell significantly, or I should say, very strong, on par with the Nasdaq. 811.30, up 15.90. That's about 2% up move on the day. The VIX 1771 down 184, so the VIX has peeled off another 10 cents. The dollar index 79.69, down 4 2/10 cents. Gold 1652.70, up 3.10, right where it was, and crude 104.59, up $1.67, very close to where it was trading before. Now, you look at a day like today, up $21 immediately after a pretty boring day yesterday, for lack of a better term, after some interesting market action. But you look at a day like today and you say, what's really happening here? Well, you have some positive earnings coming out. We'll talk about those here in just a moment. You have a decline in borrowing costs for Spain, which is essentially removing, I think, a bit of the nervousness from the marketplace, at least from a global perspective. The 10-year Spanish bond dipped a little bit below 6%. And then you had, again, and this is fuel, I think, for the Nasdaq here. Intel came in yesterday with global chip revenue up about 1.8%. Earnings today, so far, we've had, I think, 3 major movers so far. Coca-Cola earned about a little over $2 billion on 89 cents per share, which is up about 8%. It topped analyst expectations by about a penny per share. So as we look at Coca-Cola today, and what it's essentially doing. I mean, we saw a gap up yesterday. We were trading right around 72.5. We're now trading as high as 74.5, so it's about a $2 move to the upside as we approach resistance. But if we were to close, I think, where we are today, that is a 52-week high, and we would be trading higher than our previous resistance. So I think there's some interesting upward momentum here, especially if you think the overall market here, especially if you think the overall market here is strong and going to continue here into the 1,400 level, at least in the S&P 500. And I think if we look at what that means to the options, or how do we play that from an options perspective, you see implied volatility here relatively cheap. You see implied volatility here at around the 21 to 15% level. So the front month, pretty much dead. If we look at May here, and you're thinking to yourself, it was a significant $2 move to the upside, where we've now surpassed resistance. What is a potential play here? Well, with volatility so low, you have the opportunity to buy something at a relatively cheap price. If you look at the 72.75 call spread in May, as I buy this vertical, I want to show what it actually is doing here. It's a $2.50 vertical spread. You can pay $1.55 for it. So at maximum, you make another $1, a little under $1, about 95 cents. But why is this interesting? Well, the opportunity here is to make 95 cents, but it's intrinsically worth about 30 cents right now. So basically 30 cents profit. So if it were to expire exactly where it's trading today, this thing should be worth about $1.80. So if we look at essentially where Coca-Cola is, it's 74.40. You have something with it has to move basically 60 cents to the upside in order to make max profit here, which is 95 cents. So if you believe Coca-Cola will be trading above 75 from now until the end of May, you could pay $1.55 for the opportunity to make $1. So it's an interesting play here with such low volatility, even though, and because it is in the money, if you would actually analyze this position, it has a positive theta trade. When you're buying these spreads that are actually in the money, you have the opportunity to be positive theta. So if you look here, it's actually for every one spread, you get basically 13 cents in terms of theta. What is theta? Well, theta is time decay. So essentially, there's basically three things, and I have said this before, and I'll continue to say it in the future. There's three things guaranteed in this life, and with today being tax day, there's no better saying I think that fits here. You have death, taxes, and theta. In other words, options are always going to be melting in terms of their extrinsic value. They're always going to be shedding their extrinsic or their time premium. And why is that? Well, if we look at an option here, let's just look at this. This 75 call, the opportunity to buy Coca-Cola at $75 is now trading at, let's call it 76 cents. Well, if Coca-Cola is trading in the marketplace at $74.40, that's 60 cents cheaper than 75. Why would I ever want to pay, basically, why would I ever want to pay 75 when I can just go to the market and pay 74.40? Well, the reason there's anything assigned to that option at all is because there's the opportunity for Coca-Cola to be trading higher than 75. And because there is that opportunity, because there's time, because there's volatility, this option has value, and it's extrinsic value. But as you get closer and closer to expiration, if Coca-Cola never moved and stayed at 74.40, the option to buy it at 75 is intrinsically, it's going to be worth less and less as we approach that expiration. If you only have a day for the option to be in the money, would you pay 77 cents for it? Well, absolutely not. And that's the whole idea behind options or extrinsic value. So as you've seen in a hopefully a good example, that these options are typically made up of extrinsic premium, and they're shedding their extrinsic value, their time value into expiration, and that's what theta is. Theta is a measure of that decay of options due to the elapse of time. Now, as we go in, and we've talked just a little bit about Coca-Cola, which is one of the several companies which is reported today. And what was interesting, I think, about them topping expectations is why. And they came out and they said, basically global demand, global volumes has increased by about 5%, which I think is very, very interesting here in terms of Coca-Cola. If you're someone who's looking to diversify the portfolio in any way, but without literally investing in companies on foreign exchange, Coca-Cola has a significant amount of business overseas. It's a I shouldn't say terrifically, I don't want that to seem as if it's some sort of advice, but it is very diversified in terms of a company. 28% of its revenue comes from Coke. Interestingly enough, 20% of its revenue comes from Diet Coke, and 14% comes from Sprite and Fanta. So if you were ever interested in what actually was driving that revenue, it's Coke, Diet Coke, and Sprite. But interestingly enough, if we go to the opposite side of the spectrum here in terms of finance, Goldman Sachs, of course, is making news for something other than rhetoric published in memos. $118.40 on the day, up 66 cents. So Goldman Sachs, interestingly enough, came in at $3.92 earnings per share, which was bettered expectations by about 10%, so 39 cents above what expectations were. Revenue was down 16%, though, to $9.95 billion. So almost $10 billion was made, which was above expectations. It was, however, down 16%. From year over year, and trading units suffered, I think, really basically on lower volumes and revenue. I mean, we've seen definitely at the end of last year really the doldrums of trading, and so the trading units have suffered just a little bit in terms of volume, and obviously that reflects in volume. Their fixed income, commodity, and currency division was lower by 20%. So if anywhere you could reflect on what was really happening in terms of volume, that division of Goldman Sachs was down 20% year over year. Came in with just under $3.5 billion of revenue for that section of the company. And I think what's interesting about that is, if you look year over year, what was happening with commodities, basically with Forex and commodities, you had basically a 4% $4 trillion market last year versus a $4.1 trillion market in 2011. So actually an increase in contracts. But if you saw what was happening, again, just towards the end of last year, very, very light in terms of volume at the end of the year. So what does that mean from a strategy perspective as we start to take a look at Goldman Sachs, which has had an incredible ride, basically from 150 to 80 up to 150 and everywhere in between. We've now seen a high over the last 6 months of about 130, peeled off to about 115, now up a couple of dollars from 118.37, up 0.5% on the day. You know, if you're looking at this, you have to say, what are your previous resistance areas to make this interesting support? So 105, clearly, I think, if you're just looking at it from a technical perspective, is some sort of support area on the chart. You have immediate support, I think, here at 115 with 105 right behind it. If you start looking at this, and if it's a bullish play, we'll look at both, but if it's a bullish play, somewhere at 115, there's the opportunity here with volatility right around 33%. So relative to the overall market, we're talking about 80% increase over what the overall market is giving you in terms of volatility. So there is the opportunity, I think, to sell a little bit of premium here. If you're looking at 115, you take in $1.38 on the 115, 110 call spread, which is about, you know, it gives you about a 66% chance probability of success selling the 115. It gives you a break even of about 113.70, 113.62 approximately. So there's I think an interesting support level there at the immediate 115 level. To get a little bit more conservative, the 105 100 in May brings you 35 cents, but you have to look at the risk reward scenario here because you're essentially risking $4.65 to try to make 35. I think if you do anything there, you know, you tend to look at the 110 105 if you want to get a little bit more conservative than the 115. Which is trading at 72 cents. But again, in terms of the risk to reward here, if you're going to try and play Goldman Sachs, at least in the next 4 to 10 weeks to expiration, the opportunity here to sell premium on the put side is leaning itself more to the 115, 110 from a risk to reward, where it makes sense from a risk to reward perspective. On the upside, you have 130, which was essentially the last, I think, resistance area. So you've seen earnings already come out at 118, and you look to the upside and you say, hey, what is the opportunity here to get a couple of strikes away? And even at the 125, 130, it's about you're risking 4 to make 1. Which is, I think, on the upper end of the risk-reward spectrum that you'd be willing to take. But I think it definitely is there. I mean, at 125, that's $7, basically a $7 move higher, which is about a 6 to 7% move to the upside. So I think, if you're looking at Goldman Sachs here, whether or not you're bullish or whether or not you're bearish, the opportunity to sell premium is there because the volatility is lending itself. But just keep in mind, obviously, of what those strikes and what your risk rewards are, because really once you get outside of a certain area, the risk reward and those 5 wide strikes start to not make so much sense. So as we round it off here, we've got another 15 minutes or so. Let's go ahead and move into Johnson & Johnson, which was another security that had earnings today. It's really been waffling a little bit, basically, after those earnings. You saw a significant move to the downside. Buyers brought us back up to 63.91. We're now basically unchanged on the day. But we did have, move higher a little bit earlier today. So you have 63.50. Essentially, we're getting earnings report right on support. And if you've ever seen a range-bound market, Johnson & Johnson is the market. Basically, ever since August of this year, you've seen an incredibly range-bound market that has basically moved in tandem with what volatility was doing in the overall market. So as you saw, basically this is representing about a 30 to 45%, basically a 20 to 30% VIX here. You're seeing a range-bound market that represents a little bit wider range, and as volatility came in a little bit, you're seeing still the same range-bound market with the upside of $66, downside of $63, so a little bit tighter range, but still the same type of market. So before we go any further with Johnson & Johnson and the range-bound market that we want to talk about here and positioning, actually putting on some positions that might take advantage of this range, let's go ahead and take a quick call from Matt in San Mateo, California. He's got a question on Intel, INTC. Matt, you're on the air.
Hello, Victor. Thanks for taking my call. Yeah, Victor, I wanted to ask you about Intel. It's one of my largest positions. It is actually my largest position, and I've had it for a while. So I'm well in the green with it, thankfully. But they're reporting earnings tonight, and I wanted to ask you if you see anything in the options market that it would make you bullish or bearish if you see it going either way.
Yeah, that's a great question. So as we look at the options, we look at trading here. One of the interesting opportunities that you have with the ThinkorSwim software is just to take a look at the call and put activity and something called the sizzle index. We have both in the ThinkorSwim software the call sizzle index, the put sizzle index, and then just a general sizzle index. And what that gives you the opportunity to do is, again, measure today's option volume at any one particular time of the day. This relative to the time of day versus the 5-day average. So you're able to actually see, hey, are we trading more options in general? And if that's the case, are we trading more calls or trading more puts here? So I'm going to go ahead and add Intel onto this watch list here. And what's interesting here is we look at the sizzle index. That means we're trading about, or the index is showing us about I'm going to round up here, about 2.3. So that means about a little over 2 times its normal or 5-day option volume is taking place or is traded so far today. And on the call side, there's about 1.5. On the put side, there's about almost 7 times the normal option volume is being traded today on the put side. So here's what you kind of do with that information. As we start to look at where is the significant volume, I literally go through each part of the chain on the put side and start to see where is that volume happening. So you've got at the 27 and 28 strikes in April, you've got about 14,000, 36,000 contracts traded. As we keep moving here into May, you see a significant amount of activity really around the 27 and 28 level. As we go out into June, you're seeing similar 27 and 28. That's under the marketplace, so there's some clues here, and we'll talk about what that's telling us here in just a moment. 26 and 27 are the active contracts in July. And then as you get out into October, there's not much trading. So really, a significant amount of activity is taking place here in the April chain. And that could be just some short-term, I think a lot of short-term activity here at the 28, 27 level just to try to take advantage of about 20 cents. You can make about 20 cents in selling the 28, 27 spread here in Intel, or 28, 27 put spread. And if you were to do that, again, that's about a 4-to-1 because, selling the 28, buying the 27, you get about 20 cents to do that. It's a $1 wide spread, so there's 80 cents of risk, and you make 20 cents. So I think to me, at least these numbers in this chain, the way they're matching up very similar, and we'd have to go through this chain and really match up these numbers, but it looks like there's a little bit. You can't always say because there's more trading on the put side that it's necessarily bearish, because what could happen? I could be long Intel as you are, and as you go into earnings, you could say, I'm looking to hedge my position. And if I have a large position, I'm going to buy puts to hedge my position. So even though there's some put trading happening, I'm much more bullish than I am bearish. I'm taking a short-term hedge on my longer-term position. And then sometimes if I'm trading puts, I'm selling puts as an actual bullish indication. So we have to make some inferences here, but if I were to look at this, I see a little bit of the 28 and 27 strikes here, which are out-of-the-money put activity. In some cases, at least on strategies that we talk about on this show, that would tend to be selling a little bit of premium there in terms of Intel. If I look at the straddle here, Matt, if you were just looking at, hey, what's the dollar amount to expect, you're basically looking at about, maybe a 70-cent move. Because if you look at the 28 straddle here, the 28 straddle's trading at about $1. You call it about $1.05. And the one strike out of the money strangle is trading about 30 cents. So if you essentially take that that dollar that the straddle is worth, you subtract the 30 cents or so, you get about 75 cents. Divide that in half, you're probably expecting about a 30 to 40 cent move based on earnings. So that's kind of the expectation there. So somebody selling that 28, potentially selling that 28 put, when the expectation is somewhere in between 40 to 50 cents, you can see, well, it's trading at 28.54, so even a significant move to the downside, that 28 strike might be safe. So there could be some interesting things there. Obviously, we're just making inferences based on the volume that's happening there, Matt. But I think it's an interesting and a very interesting question, and it's going to be an interesting play.
Yeah, I think it's actually very useful for me because what you're telling me is that there's not an expectation for an outsized move. I mean, this sounds fairly modest, right, in terms of earnings-related moves. I
think it's relatively modest, just again, based on what that straddle is doing. Yeah, exactly.
Yeah. So it wouldn't even be worth it buying protection for it. At least that's my take then.
Based on the expectation, and again, you always have to keep in mind that what is that really telling us? Well, the expectation, just as in math, that's 62% of occurrences. So obviously, there is the 38% chance something comes in and something happens there. But we're talking about the expectation, which should cover you 62% of the time, right? So there's always the opportunity that something happens that we don't know about. But again, their global chip demand is up a little bit quarter over quarter versus last year, up about 2%. So it'll be interesting.
Yeah. Okay, great. Well, thank you very much for your help.
Absolutely. Great call, Matt. We appreciate it. Again, Matt from San Mateo, California. We're talking about Intel and really what the option chain can tell us here. So it's a great call. And if there's any others out there as we wrap up the show, feel free to give us a quick call at 877-927-6648. And again, we wanted to wrap up our last example here in terms of Johnson & Johnson because this is one of the most fascinating range-bound markets that I think we've seen over the last 8 months. But making a low here at about 63, basically being range-bound from 63.5 up to about 66.25, we can start to look at that options market. And we can start to look at potentially what it's telling or giving us. Obviously nothing here in April, but if we look out in May, the premium there at 65 versus the premium at about, let's call it 62. So really, basically with the strike availability, you're looking at basically selling the strangle. And that is selling, and I don't mean you're looking at it. I'm saying if we're trying to do something that's range bound and take advantage of these of this range, if the thought process or this strategy that is to be employed, and again, we're just using this for examples, but it's that, this is interesting, this 63 to 66 level, I want to play that potentially Johnson & Johnson stays within that range inside of the next 31 days. How do I do that? Well, then the opportunity is to sell the 65 call, sell the 62.5 put. You put those together, and now you're sold a strangle, is what that's called, for about 73 cents. And if we analyze this trade, you can see what happens. Anywhere in between there, I'll make the 73 cents or $73, and then outside of, basically, it also gives me a 73% range, or 73% cushion on the outside of those strikes. So my break-evens here are 61.67 to the downside and 65.72 to the upside. So you can see if I set these slices to my charts, as I'm going to do right now, I'm going to set these to my charts. And what happens is you can immediately see where this trade is profitable. Anywhere inside of those lines, this trade is profitable. And if you can see where we've traded, it's a very interesting level. We are right smack in the middle of really where this break-even would be. And the risk is that we make a little bit higher highs than we have over the last 3 expirations or so and end up expiring above 66. But there are ways to potentially as we get a little bit higher, maybe you're selling the same strike again, and you're widening out your break even. So, but again, as always, on this show, we typically talk about range-bound strategies. And this is something, or I should say risk-defined strategies. And as we look at this, this has essentially unlimited risk because you're selling a call and you're selling a put, and you're doing that unprotected. And if that's something you're not quite comfortable with, there is the opportunity to change that just a little bit. So we're doing this at 73 cents. There would always, of course, be the opportunity to buy something out of the money. And the great thing here is with volatility so low at 15%. Well, volatility so low is as you get out of the money, you almost pay nothing to buy a little bit of protection. So, if you were to go out to the 57.5 here, right, and you buy the 57.5 call, you go out to 67.5, and you were to buy that call. You buy the 67.5 call, the 57.5 put. You now look at where we are here. You'll now bring in 60 cents, right? So you now bring in 60 cents, which is a little bit less, 13 cents less, but again, you've shored up your risk. On the most you can lose, I think, here to the upside is $200. And why did we make it a little tighter to the upside than we did to the downside? Well, because we know in the charts, if we look at this, there's the opportunity is a little bit closer to the upside than it is to the downside. So if, in fact, we do make a little bit of a bullish move, in this particular instance, we would lose less to the upside. So we're positioning our position the same way our expectations might line up. And to the downside, we would never lose more, in this particular example, than $440. So we've gone over a gamut of different strategies here today, a gamut of different securities. We look forward to the earnings coming up. I would say keep your eyes on Yahoo, AMD, Verizon, Citigroup, AXP, that's American Express, BAC, Bank of America, COF, that's Capital One, MS, that's Morgan Stanley, and GE, that's General Electric, which a lot of people don't know. Finance essentially drives that revenue. So as always, I want to thank everyone for listening to the last hour of the Options Hour here on TFNN with Victor Jones. We'll be here at the same time, same place next week. Thanks, everyone, and have a great week trading.